Hi, everyone, and welcome to UBS Trending. I'm Anthony Pastore. The amount of volatility and inflation that is impacting markets is only growing. And just this week, the Federal Reserve responded by raising interest rates and their inflation forecast. So how will that impact the markets and your investments? And what can we expect in the weeks and months ahead? So we're going to talk about that right now with my colleague, Leslie Falconio from the Chief Investment Office. Leslie, good to see you. Lots to talk about today.
You. Absolutely.
So we know the Fed raised rates. We're going to get into that in a moment. But I have to ask you first, because a lot of folks are certainly concerned about the war in Ukraine. Certainly, first and foremost, from a humanitarian perspective, our thoughts always go out to the people of Ukraine first. And then you have to think about the market implications and how much of the action that you're seeing right now in the markets, particularly with treasuries, although we can talk about that in a minute when it comes to what the Fed did. But we've seen a lot of action prior to the Fed raising rates. How much of that is tied to Ukraine?
Well, I mean, it's interesting, Anthony, because we came into the year with the expectation that interest rate volatility would be relatively high. I mean, we saw the Fed shift, in December to be much more hawkish. We didn't know what the Omicron variant would actually, the outcome would be. We had credit spreads at multi-decade tights. So that actually turned out to be the case, that interest rate volatility really spiked even in January. Mm-hmm. Now, when you add on the unfortunate situation that we're seeing overseas, that's obviously compounded, and it has for a number of reasons. I mean, one is the fact that obviously the U.S. is viewed as sort of this safe haven or flight to quality, right? So we have a lot of investors moving into U.S. Treasuries just as this vulnerability continues to exist. We also have sort of like the second order effect in terms of what's happening with, say, the funding markets, right? So when you have this kind of dislocation, whether, some regions will have stronger growth than others, and particularly when you have a volatility with what we're seeing in Ukraine and Russia, you have a lot of sort of aftermath. And one of them is being the interest rate volatility that we're seeing. Interest rates come down to the flight to quality, but also the fact in terms of how these funding markets or the potential credit risk could sort of spiral. And the one thing I will say is that, this has a long way to go, right? We don't know what the impacts will be from, sanctions or the outcome of Russia and Ukraine. But I think it's important to really take a look at how the U.S. is performing and not sort of take a movement into every spike that you see, but really look over the longer term.
Mm-hmm. It is incredible to see the market reaction on a day-to-day, sometimes a minute-by-minute basis, depending on what's coming out from the news flow of what's happening on the ground in Ukraine. Are there peace talks? But then there were more attacks. The market goes up, it goes down. Oil goes down, that goes up. So it's incredible. And we're seeing the same thing on the Treasury side. But then you've got to factor in the fact that Jay Powell and the Fed decided to raise rates 25 basis points, which, of course, was well expected ahead of the meeting, which it seems like every single economist and analyst on the street was saying, yes, they're going to go at least 25. And with possibly 6 more to come this year. But break down what that means, because not only that did they raise rates, the Fed also raised their inflation forecast to 4.3%. So break down what that means, especially for investors in the markets.
Sure. Well, when we think about the volatility, let's talk about the volatility of interest rates again, and just think about in like March 6th or 7th, 10-year rates were like 167. They moved all the way to a 224 yesterday after Powell. That is a really large move in a very short period of time. And we've often talked about how that kind of velocity could be a headwind to performance for both, for fixed income and particularly the credit markets. But one of the things with Powell yesterday is that the market was anticipating 7 rate hikes this year. So that wasn't really the real surprise. What the real surprise was, in that hawkish sort of overtone, was the fact that the rate hikes that they put in for 23 and 24. Now, as you pointed out, not only has the situation, overseas spiked up, say wheat and gas and oil, although they come back down, we still have a lot of unknowns in terms of these supply chain bottlenecks, right? Now, hiking rates won't cure supply chain bottlenecks. It won't cure sanctions. It won't really have any impact on those kind of variables which are pushing inflation higher. But when they hike interest rates, what they can do is lower consumer demand. Mm-hmm. And this is really the delicate balancing act they're really trying to face right now, and that tightrope that they're walking. But one of the things that Powell did reiterate numerous times is that it is the belief that the consumer is strong enough and the economy is strong enough where that it will be able to withstand these rate hikes. And one of the positive things out of the outcome that we saw with the Fed, regardless of the fact that they were a bit hawkish, is that now you have a known. Now, we call it sort of like ripping that Band-Aid off. Now all the speculation and this concern that the markets were having, that the fixed income was having, that the credit markets were having prior to the March meeting is now known. So we're seeing a little bit more stability today.
Right, so we can actually take a breath, make informed decisions now, knowing where the Fed's thinking is heading towards. And you made a really good point, because they in Powell's press conference afterwards, someone asked him about the risk of recession, and he said he thinks that the economy is very strong, but he emphasized the need for price stability. So I wanted to ask you, Leslie, what's your thought on the fear of recession? The question is being asked a lot, probably not surprising to everybody, because of so much uncertainty and the volatility. And we haven't even really gotten into the fact that China is in the middle of a COVID shutdown right now. 51 million people plus are quarantined. So there's concern about supply chain issues respiking. How does this all play out to a potential recession?
Well, I mean, it's interesting because one of the biggest debates, and this is all over the media, and it's true, do they have the ability to actually maneuver a soft landing, right? Does the Fed have the ability to maneuver, particularly when you're out of the gate with someone's hiking and such strength? And meanwhile, let's not forget they're doing quantitative tightening, right? They're unwinding the balance sheet.
That's right.
So when we
Which they also mentioned they were going to do more of that. A little bit.
Probably most likely to start in May.
Right.
But this is a really, I mean, they're going out of the gate strong, right? So now we can assume that the Powell is taking that sort of stance because he does believe the economy can hold up. History would show that would be debatable, right? History would show that when you're looking at a terminal rate of 275 and all these and a lot of some of the headwinds that we're seeing, a little bit of downturn, whether it's ISM or leading indicators or things like that, it could be somewhat of a debate. Now, in terms of the recession, I think that what we really need to pay attention to when people think of the word recession, it really depends on the severity and the depth. I don't think anybody would argue that 2 years from now it's very likely, right? I don't think anybody would argue that. Probably not even Powell. But it really depends on what is sort of like the sustainability and the depth of the recession. So if there is a recession, it could be shallow, right? It could be technical, 2 negative GDP quarters or things like that. I mean, things that are not one that is something that, puts the economy sort of completely, on its back.
And I'm glad, by the way, that you pointed out the technical definition of recession.
Yeah.
A lot of us think of recession as what happened in 2008 and 2009. It was a, significant recession. But technically, a recession only means 2 quarters in a row of negative GDP.
Right. So, I mean, I think that what we're saying is, with that said, is that it's important because people, to your point, think fat tail risk. And that's not necessarily the case. I mean, recessions can be shallow. And, we're not predicting what the recession might look like right now because you have to look at the data. There's no question. But I think that the probability of one is in the next couple of years is probably pretty high. And I think the market expects that. Overall.
Right. So that begs the question then for an investor who's listening to this conversation and getting a lot of information from you, and we've heard information from Powell, and we know the volatility is probably not going to go away anytime soon with everything going on geopolitically. What does the down the road view look like, and how do investors position themselves here?
Well, I have to say, I mean, we haven't had this kind of opportunity in fixed income in quite some time.
Why do you say that?
It is, well, I'll tell you, one of the things that we've had, if you think about since March 2020 and the shutdown, right, we've had all this accommodation, both fiscal and monetary, yields are coming down, spreads are compressing, and it was great, but the opportunity set became narrower and narrower and narrower. Now, whether we like it or not, within a very short period of time, interest rates spiked and spreads have widened out, right? So when you look at today's levels and to look at today and going forward, you really have not only the benefit of, as we sit at around that 224 level in 10-year yield, you're as high as you were going back to July 2019. So you've started to normalize, and we don't think interest rates are going to go back to 2018 at 3.25. So you're starting to normalize in rates, and also as an investor, you're being compensated a lot much more in spread. So you have a lot more cushion. And that's also, remember, as well, is that the fundamentals within the market, within fixed income credit market, whether it's mortgage credit or corporate credit, we believe are very strong, right? They've termed out debt, very low rates, and interest coverage ratios are very good, defaults are low. So the opportunity set is widened out for fixed income investors. Now, we have to understand as well that it's not just clear sailing, because as we know, and as you pointed out, that we're going to have these pockets of vulnerability along the way. The Fed is coming out of the gate strong. The data is going to be dependent. We don't know all the outcomes of Russia and Ukraine or what these sanctions might evolve into. But when it comes to the opportunity set, it's much more ample today than what we saw 6 months ago, 8 months ago, 12 months ago. Now, from our perspective, where we're looking at, our view has always been sort of this type of barbell, right? As you know, we've been long this asset class for quite some time, the senior loan side, right? We like those floating rate assets. It really, it takes away that interest rate volatility that we see because it's floating rate. We like the fact because if the Fed is hiking, you're earning much more carry. But we also, at these levels, you can't ignore or can't really say to yourself, I shouldn't be having any interest rate risk because you're at that close to 224. We've done that in the credit side and the preferred side. So I do think that opportunistically in fixed income right now, it's probably the best that we've seen in quite some time. Is that a clear sailing? No, but at least you have the cushion in terms of spread and carry that gives you much more of that sort of protection than what we saw 6 months ago.
Right. And look, if the Fed is going to go 6 more times this year, already we're seeing 30-year rates on mortgages, fixed loans, above 4% for the first time in many years. So 6 more hikes down the road, you might maybe see a little bit of a cooling of the housing market because it is hot, hot, hot right now and prices are on another level. But that seems like to be what Powell is doing. He's like, we've got to get these prices under control, not just for housing, but everything. I mean, this inflation that we haven't seen in 40 years or so is so ridiculously hot right now.
It is, and I think to that point, that's where sort of like the cooling of consumer demand comes in when you raise rates, right? If you want to try to like stabilize inflation a little bit, as I said, hiking rates doesn't do anything to supply chain or sanctions, but if you hike rates enough, consumer demand starts to come down.
Exactly.
And your borrowing costs go up, such as mortgages, your credit card, things like that. The belief is, and we feel the same way too right now, is that the economy is strong enough, the consumer is strong enough, well, they'll withstand that rise in borrowing costs.
Mm-hmm. Powell said the same thing. Got hot jobs, a good jobs market, strong economy. He says there's barely a risk of recession, so we'll see. Got a few more meetings for the rest of the year from the Fed and more conversations with you, Leslie. Always good to see you. Thanks for joining us.
Thank you.
Great. And there's a lot of information on our website from Leslie and the rest of the Chief Investment Office. ubs.com/views is that website. And you can also make sure to follow us on social media. We've got content on LinkedIn, Facebook, Instagram, and Twitter. And all of our UBS Trending episodes are available as well on demand on our website and on YouTube. And as always, if you have questions about your portfolio, please speak with a financial advisor. Until next time, I'm Anthony Pastore. Have a great day. And remember to keep your eyes on what's trending. We'll see you soon.